Hey everyone, welcome back to our monthly market pulse. Today we're diving into one of the biggest shifts in real estate we've seen in years. The market is changing fast and it's affecting buyers, sellers, and investors in big ways. So is it a simple correction or a full-on market shift? Stick around until the end because I'll share my personal take on that question. And trust me, it's not what you're hearing in the headlines. Here's what we're covering today. Number one, the current state of the housing market, what the numbers really say. Number two, why inventory is at a 5-year high and why it's not quite as simple as it sounds. Number three, the price paradox, how we can have record high sales prices and record cuts at the same time. Number four, regional breakdowns, including a deep dive into St. Louis, which is my market, but it also reflects a lot of the other markets in the country. Number five, the economic backdrop, inflation, GDP, jobs, and how they're weighing in on the market. Number six, forecast for August and beyond. Number seven, and finally, my advice for buyers, sellers, and investors who need to navigate this great rebalancing is what I'm going to call it. Before we get into the data, let's define a few terms. A seller's market, that's low inventory with heavy competition and sellers calling the shots. A buyer's market, more homes for sale, longer time on market, and buyers negotiating the price and the terms. What we're seeing now is a shift towards balance. And in some areas like Miami or Austin, it's an outright buyer's territory, and that has not happened in several years. Zillow calls this shift the Great Rebalancing, and it's a perfect name. After years of sellers dominating the market, we're seeing the power shift back to buyers. As of the end of July, 50 of the largest metro areas are now considered neutral. Last year at this time, there was only 8 that were considered neutral. Bidding wars are cooling off. Only 31.2% of homes sold above list price in May, compared to nearly half of those in peak years. The average number of offers per listing dropped from 2.9 offers per listing to 2.4 offers per listing, and nearly 15% of pending sales were canceled in June. That's the highest in a month since 2017, according to Real Estate News. That's leverage in action. Buyers are willing to walk away if the deal isn't right. Let's talk inventory now. We hit 1.36 million active listings in June. That's up 17.2% year over year, and that's the highest increase in 5 years according to Zillow. That sounds great, right? More homes for everyone? Not exactly. New listings fell 3.2%, which is very rare in summer. This isn't a flood of new sellers. This is stale inventory, which means homes are sitting longer. The median days on market jumped to 39 days, the highest since June of 2020 when no one knew what was going on. Expired listings are up 17.6% year over year, and that's what I like to call phantom inventory. Lots of listings, but not a lot of quality, fresh new options. All right, now let's dig into the price paradox. Now here's the confusing part. Prices are sitting at record highs. The median sales price for existing homes in May was $422,800, the highest for that month ever, according to NAR. But at the same time, 26.6% of all listings had a price cut in June, the highest for any record in June, according to Zillow. Why? Because prices are high, growth has stalled, year-over-year increases slowed down to just 1.6% year-over-year increase, down from the 5 to 6% that we were seeing earlier in this year, according to Redfin. Sellers are adjusting to the reality, and buyers aren't biting at the pandemic-era pricing. We are also in a transitional gridlock. Realtor.com projects only 4 million existing home sales in 2025, which will be the lowest amount since 1995. Why? One word: affordability. To buy a median price home, a typical household needs a $17,000 raise and $73,000 in cash for a down payment, according to Zillow. Combine that with the lock-in effect, where millions of homeowners are sitting at a sub 4% mortgage, and they just simply refuse to sell and trade up to a 7% mortgage. And you've got a market gridlock on both sides. All right, let's do a regional deep dive right now. I'm going to talk about a few specific markets, but I think this can be mirrored in most markets. The national averages can be misleading. The Sun Belt markets like Miami, Austin, or Tampa, they're shifting hard into a buyer's market according to Zillow, but in the Midwest and the Northeast, affordability is keeping demand alive. Take my home market, St. Louis, for example. The median price in the city is $224,660, which is up 2.7%. And in O'Fallon, which is where my office is, O'Fallon, Missouri, it's $367,950, which is up 5.1% according to Rocket. And the homes there, they're going under contract in 4 days, with over half of them selling at list price or above. Even the luxury market there is affordable compared to the coast, with the top 10% starting around $697,000. That's why these markets are still moving, because prices and affordability are there and supply is low like it is everywhere else. Now let's zoom out a little bit. GDP contracted to negative 0.5% in Q1, but rebounded with an estimated, hopefully, growth of 2.4% in Q2. That's only 1.5 to 1.7% combined projections for the year, which is not a strong economy. Inflation is sticky. The core PCE is at 2.67%, and the new tariffs threaten to push up prices again, although that has not been proven yet. Job growth did slow in June to 147,000, and the unemployment rate rose to 4.1%, which is historically low, but it is higher than it has been. Consumer sentiment and consumer confidence is sitting at 61.8%, which is way below the historical average of 86%, according to the University of Michigan. And the mortgage rates. The 30-year fix sits at 6.74%, with projections holding between 6.5% and 7% throughout the end of the year, according to Freddie Mac. And that translates to a median monthly payment of $2,679. Realtor.com does expect slight easing to 6.4% by the end of the year, but Redfin is predicting 6.8%. Either way, the new normal is going to be 6 to 7%. So what's next? For August, expect elevated inventory, peak price cuts, sluggish sales, and maximum home buyer leverage. For the rest of 2025, the projections do vary. Realtor.com expects prices to rise nationally 2.5%. Zillow is forecasting a little bit more conservatively at a 2% decline. So the point is, there's no consensus. There's not going to be a crash, but there's not going to be a boom. There's just going to be somewhat of a bumpy landing. So here's my advice for buyers, sellers, and investors. For buyers, this is your time to negotiate. Target stale listings, use comparable data to justify offers, and budget conservatively. Don't stretch. For sellers, price competitively from day one. Presentation matters, staging, photos, move-in ready, and be flexible. Concessions like closing costs can win you the deal. And for investors, factor in slower rent growth and higher borrowing costs, but note, all cash buyers still account for 29% of transactions according to NAR, and that's real competition. So is this a correction or a shift? In my view, this is a full-on rebalancing. The days of runaway price growth and bidding wars are over. What's ahead is a more strategic, data-driven market, and if you're a buyer, know your numbers and negotiate. If you're selling, be realistic on pricing. The easy money days are gone, but the opportunity, it's still out there, and I'll see you next month for the next Market Pulse update. If you got any value out of this, make sure to like and subscribe, and I will see you on the next video. Hopefully you learned a little bit.